Hi, we're talking about Chapter 8 today. So this is video 1 on Chapter 8, and we're going to get started by reminding ourselves of what? How about that? Audit risk is equal to inherent risk times control risk times detection risk. So this goes into all our decisions and why we do things when we're on an audit. So we want to keep our audit risk very, very low, right? Audit risk is the risk of getting the audit wrong. Well, it's based on the risk of material misstatements, right? How likely are those financial statements to be misstated? That's the risk of that. And detection risk, that's the risk of our audit. We won't detect it, all right? If there's a material misstatement and the controls don't prevent it, it gets in the financial statements. If we don't detect it, right, then that's on us. So we can't really do anything about inherent risk or control risk, right? But we can do something about detection risk, right? We can change the nature, extent, and timing of our audit tests. And that is how we keep audit risk very, very low. All right. So when we're on an audit, our first step for whichever part of the cycle we're in is to understand the inherent risks, right? So that means we have to understand what's going on at the clients with respect to that part of the cycle. So the cycle we're talking about today is acquisition and expenditure. In other words, we're spending money, we're buying things. Acquisition, we're getting inventory, we're getting property, plant, and equipment. And we're expending, so we're paying out our cash, we're having expenses, we are accruing liabilities, we are getting intangible assets, all these ideas behind acquiring and expending. So you have to first, right, understand the cycle so you can understand the risks, all right? So somewhere, whenever some money is going to get expended at one of your clients, right, either for a purchase or for an expense, it starts with something called a purchase requisition, right? No company is going to let just anybody buy whatever they want and then pay for it with the company funds, right? So typically, in order to control this, there's a document called a purchase requisition, and let's say the manager of the department who needs to buy something fills out this form. Maybe it's online, maybe it's an actual piece of paper, but the control authorization is used to make sure this purchase is needed and the right person is purchasing it, that kind of thing. So purchase requisition gets filled out, it goes to a department, typically they call it the purchasing department, and it gets authorized by whoever needs to authorize it. Maybe some department chair, maybe some division head, it gets authorized. And it gets sent off to a vendor on a piece of paper called a purchase order. And again, could be on a computer screen, but here's another control. We've got the requisition, somebody who's okay to ask for it, asks for that thing that needs to be purchased. It goes and gets authorized, then it gets sent out as a request to the vendor. We would like to purchase this thing from you. So it's called a purchase order, right? And so that's just another document, another accounting document. Once that purchase order happens, it goes out to the vendor, and of course they're glad to have our business, and they ship whatever that is we bought, or they provide that service, whatever it is we're purchasing. It comes to us. We get it. Yay. Well, there should be a document called a receiving report that gets filled out, right? So you can imagine a warehouse where there's tons of purchases coming into, needs to be kept track of, right? So important internal control is this receiving report. It lists all the stuff that's being received. That's all it is. All right. So now we've got somebody's requested it. It got authorized. It got purchased from an authorized vendor. We received the stuff and that got noted, right? And it's in a warehouse or it's given to whoever needs it, so that stuff is there. Maybe it's inventory, so it goes to store, whatever it is we purchased, it goes to where it needs to go. Then those people who we purchased it from, that vendor, well, they want to get paid, right? So that vendor, maybe it came with the merchandise that we're going to resell. Whatever it is we're buying, it has an invoice, and that's like the bill. And the vendor wants to get paid, so there's this document called a bill. Right? Well, once we get that bill, that's an account payable, right? Once we receive this stuff, now we have a liability, right? So a big part of this cycle is making sure that liabilities are getting in the right period and they're in the right amount, because it's something that we don't necessarily pay cash for right away, so it would be nice to understate those, right? So making sure those liabilities are getting on the books is what we need to understand, and we need to understand how that happens. Typically, the liability goes on the books when we receive the merchandise, and the invoice is used to enter that in the system. Now, when do we pay it? Well, we don't pay it till we get what's called a voucher packet. Here's the part that's talking about paying. So in order to pay, the accounting department is going to create what's called a voucher, just another document. And before they make that voucher, they're going to do a three-way match with the purchase order to make sure it's something we really ordered, with the receiving report to make sure we really received it, and with the invoice to make sure we're being billed the correct amount and it's the invoice matches with that purchase order and that receiving report. Then they would prepare the voucher, send it off to the Treasury Department to get a check cut and sent out. So you've got that segregation of duty the whole way. Nobody who has custody of this asset that comes in has authorization, and they don't do the accounting. So you've got this cycle that involves a number of accounts. And the thing to keep in mind is we're using segregation of duties and important controls at the client. All right, so here's your basic activities. We're purchasing something, we're receiving something, we record it, and we pay it. All right, so any step along the way, something could happen. So as auditors, what we're checking are, of course, ultimately the account balances, right? So is that inventory number the right number? Is that account payable balance the right balance, right? Is that expense the right expense, right? Is that asset value the right value, right? Because something we purchased could become an asset or it could become an expense, right? So that's what we're really ultimately worried about. We need to understand the cycle because we want to make sure that the activities involved in this cycle lead to well-prepared financial statements that are in good order. All right, so what do we need to understand? Well, first of all, what are the significant accounts in this cycle, and what are the relevant assertions, right? Back to our understanding the inherent risks, right? The inherent risk is that accounts payable, they want to understate those. So always keep in mind as you're thinking throughout this whole cycle, they want to understate accounts payable and understate expenses. All right, so do we test for everything? Oh yes, of course. It certainly is possible for something to be valued wrong, for something to not exist, but it's less likely, right? So for accounts payable, we're much more likely to understate, which goes to completeness, than we are to overstate, which goes to existence. Right? I mean, people just aren't going to make up fake accounts payable and put them on the books like they might with accounts receivable. All right? So we're typically testing for completeness first and cutoff first, just because that cutoff is a way they move those liabilities out into other periods. That's very common. They don't just take them off the books, they shove them out into the next period. So cutoff becomes very important with accounts payable. Same idea with completeness, for expenses, right? People want to understate expenses. They want to shove them out into the next period. They would like for them to not necessarily be classified as an expense. Here's something that can happen that we have to be careful of in expenses. When a purchase is made, it can go one of two ways, right? It can either be an asset you're purchasing, or it's something that is used up and it's an expense, right? So this idea that I make a purchase and I classify it as an expense is important, right? So some very famous frauds occurred by simply calling an expense an asset. The biggest one that comes to mind is WorldCom. They use some expenses as assets and really committed a big fraud there. So anyway, accounts payable and expenses, those are the big things to watch here. And the of course, here's that one I talked about, 11 billion MCI WorldCom capitalized expenses. Just so that means they wrote them down as assets instead of expenses. Waste Management, Adelphia, Orbital, Aurora, Dixon, a lot of shenanigans going on with expenses. So this is an important cycle. It's one where a lot of management fraud tends to occur. I think management fraud tends to occur mostly in revenues and mostly in expenses. All right, so, right, because what are you interested in? The bottom line, right? Net income is the big deal. How can you mess with that? Well, you can either mess your revenues up or mess your expenses down. So that's where we're at with that. So we are going to stop there. And on the next video, we'll pick up with these inherent risks and what could go wrong.